Hey guys, you're back with Steph and Dennis, and today we're breaking down all of the different levels to investing. So basically a detailed step-by-step breakdown of how every piece of the investing puzzle fits together. We'll be diving into the difference between investment platforms like banks and online brokerages versus investment accounts like taxable and tax advantage accounts versus investment types like mutual funds and index funds, and finally what those different funds are made up of, such as stocks and bonds. So if you've ever felt even mildly confused between the difference of all those different pieces that I just brought up, hopefully it'll all make sense to you in the next 10 or so minutes. So if you're excited for this video and more content like it to come in the future, show us some love down below by hitting that like button and subscribing, and let's jump right into the video.
Okay, so the first step when you're starting to invest, or in this case, the first tier, is choosing the investment platform that you're gonna be using. So this could mean the big banks if you're in Canada, so your CIBCs, your Scotiabank, RBC, TD, you name it. If you're in the States, this could mean Chase Bank, it could mean Bank of America, Ally Bank, you guys know what's up. But on the other hand, it could also mean your online banking options. So, some of our favorites include Wealthsimple, Questrade. Once again, we've talked about Webull. I believe Ally also has a self-directed investment account as well. But in terms of the online space, there's a number of options out there. Now, the key things you want to consider when you're looking into the different platforms are, of course, your cost. You want to look at the interface, and you want to look at the different features that they offer as well. So typically from a cost perspective, if we're looking at the bigger banks, they typically charge higher fees. That's just the nature of the game. That's kind of how it's always been. Things are kind of changing, but for the most part, this kind of sticks. So you want to be looking out for your fees per trade. You want to be looking for any inactivity fees. So this is something that always used to get me when I was with TD, where, I wouldn't make any trades within a quarter and all of a sudden $25 charge. So I think they've gotten rid of it by now, but that's just something you want to consider when you're looking at some of the bigger banks. Something else to consider are any withdrawal fees. So if I want to take my money out of the account, are they going to charge me a fee for that? Are there any minimum balances? Like, do I need to have $1,000 set aside, $5,000, $10,000 before I can even open an account? Ideally, it should be zero given the online options that are kind of disrupting the space. But there are still some stragglers out there when it comes to the big banks. Okay, so the big one that I want to make sure you guys are looking out for are 100% mutual funds. Okay, so quick side note and background on mutual funds. This is a product that the bank has been pushing for years. And the reason they've been doing this is because they make so much money off of this product. They have what's called a management expense ratio. So this is a fee that they charge for managing your portfolio, and it usually averages out at around 2% every single year, which obviously eats into your investment returns, right? What I will tell you though is that there's a bunch of platforms out there that have the ability and can afford to charge less in pretty much every category that I just mentioned. So if you do find, a platform that you like the features, whatever, everything that I named before, then you might as well go with it.
Okay, so now that you know more about step number 1, which is selecting your investment platform, next up is actually choosing your investment account that you're going to do your investing within. Basically, you don't actually invest within your investment platform. That's simply what hosts your investment account and has other features like customer support and everything like that. Investment accounts themselves are independent of that, and there are a few different types. Obviously, they differ depending on the country that you're in, but the two main categories are going to be tax advantage and taxable accounts. So if we start with tax advantage accounts, as the name says, there's actually tax advantages to using and investing within them. So in Canada, for example, we have what's called the TFSA, or the tax-free savings account, where you don't actually pay taxes on the money that you have within or income you generate when it's in that account. We also have the RRSP, or the Registered Retirement Savings Plan, that is a tax-deferred account. So in that case, you don't pay taxes on the money that's in there now. Instead, you'll pay taxes at the time that you take the money out, likely when you retire. And also the theory and line of thinking there is that when you retire, you likely have a lower income than you do now, so you end up paying lower taxes in the long run. Another advantage for the RRSP is that when you put money in that account now, you can actually benefit from tax deductions year over year. So for example, if I put $10,000 into my RRSP and my income is $50,000 on my tax return, it's treated as if my income is only $40,000. So typically you'd want to take advantage of those tax advantage accounts first to do your investing within. And obviously there are some different rules around using them as well, along with account maximum, so a maximum amount of money that you can contribute overall and also on a yearly basis. basis. So make sure you check out our previous videos that are really deep diving into both the TFSA and RRSP and just tax advantaged accounts in general to get all the information. Now, once you do max out your tax advantaged accounts, your next option is to start investing in a taxable account, or what's also called a non-registered account. It could also be called a personal account, basically the non-tax advantaged account. So basically in these taxable accounts is where you can do the rest of your investing. You just won't get any tax breaks like you do in those other accounts. So basically for any income generated, like interest earned, or also capital gains and so on, there will be tax that you have to pay on an annual basis. The last thing I want to mention quickly here is that there are of course other types of accounts as well to invest in. This was the high level snapshot. There are ones like the RRIF or RESP for education savings and all those other types of accounts as well. So keep an eye out for those as well. And if you want to see a video on any more specific accounts, then let us know in the comments down below too.
Okay, so now that you've selected your investment platform, you've selected an account to invest in, next up is actually selecting the different products or the different investments that you're going to be making within these accounts. So first things first, and I want to make this super clear because we get a lot of people who do those steps. They choose their platform, choose their accounts, but then they just put money into those accounts and then it just ends up sitting there because they don't actually end up making investments or buying investments within those accounts. I do want to point out quickly that if you're someone who uses an online robo-advisor, then you are set up for them to make investments on your behalf. So typically, like if you've seen Steph's Simple investment videos, we'll link those up top somewhere, but typically what she does with her invest account is she'll fund it with $1,000 each and every month. And then each and every month, what Simple will do is they'll actually make those investments on her behalf. Low cost investments, that is. So now on the other hand, if you're someone who's not using a robo-advisor and you have, let's say, a self-directed account set up, then you would actually need to go in and purchase your own investments. So that means buying different ETFs, buying different index funds. It also means buying your single stocks if you're a single stock investor. You would actually need to go in and buy them yourself. And now what we're gonna do is we're gonna actually kick it back to Steph, where she's gonna talk about what's actually within these different investment products.
Last up is what those types of investments that you chose are made up of, which is largely going to be stocks, but also bonds as well. Now, I also want to mention that you can invest in stocks directly through trading platforms and then within those investment accounts. We have a video that we put up very recently that I'll have linked up top for you here to check out more about what stocks actually are to get this conversation going. But as a really quick recap, if anyone hasn't heard before, stocks are basically little pieces of a company called shares that you can invest in. And ideally, as the value of that company goes up, you get to make some of that profit as well. So like I just mentioned, you can invest in single stocks directly. So for example, if you bought 5 shares of Apple and have it sitting directly in your portfolio. Or on the other hand, you can buy some of those products that Dennis was mentioning before, and it might contain a small portion of that company's stocks instead. Okay, so the last thing I want to mention before we wrap up are bonds. Bonds are typically less risky investments that are added into portfolios or into investment products to reduce the risk. That same video that I mentioned earlier that dives more into what a stock is also dives more into what a bond is, but at a high level, it's a loan from you, the investor, to a company or government for them to fund some sort of project. Also, one major thing to keep in mind when it comes to bonds is that it's typically something that you'd want to have more of when you're getting closer to retirement, when you're looking to reduce the risk of your overall investment portfolio. So overall, these are some of the contents of those investment products that Den was mentioning before, and it's also the final piece to the investment puzzle that we've been piecing together for you. So I'm going to wrap it over to Den to close us out.
All right, guys, so that's a wrap on this video. We hope that you enjoyed learning about the different tiers of investing, starting from the beginning. So you choosing your platform, all the different accounts that are available to you, and then you finally buying those investments. We hope that you enjoyed it. Make sure you do show us some love down below with a like. Make sure you subscribe, you know the vibes. And yeah, if you haven't checked out any of our previous videos, make sure you do check them out next door. We will be back, you know the vibes. Once again, let's go.